The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen. Welcome to tonight's webinar. Bear with me one sec. I'll get back to where we need to get to. Excellent. Hope everyone's well. Look, tonight's webinar is a investment update market review on the Tailored Investment Solutions ASX200 Series 1 units. I hope you can see my screen. Just have a look at what you've got. Bear with me one tick. There we go. Again, good evening. Welcome to the webinar. Tonight's interesting presentation. We've obviously had a lot of things over the last few days influence the share market, but not just over the last few days. Over the last 3 years of the investment, it's certainly been a volatile ride with plenty of things influencing not just equity markets or share markets, but also all investment markets that there are, not share markets, but property markets, interest rate markets. It's been a very interesting time to be involved with the investment markets over the last few years. Before I start the actual presentation, I want to go through the disclaimer. The SMSF Club are licensed. Our licensee is a company called RM Capital, which licensed myself, Justin Beaton, as an individual, and the company, the SMSF Club, to provide investment advice or financial advice to you as investors. Now, tonight's webinar is what we deem as general advice. That is that I haven't considered your individual investment or personal circumstances at all in preparation for this presentation. Now, if you haven't heard from us for a while, I think there's a fair few people who've tuned into this webinar. It's probably one of the first webinars you've tuned into for quite some time. We have expanded our offering not just for general advice, but also personal advice, where we do look at your circumstances and give you a financial plan based on investments, based on your contributions or retirement planning advice. So, look, if you want to expand what you use us for rather than just accounting and administration, and give you a few investment ideas as time goes by, and would like to get financial advice, then please send us an email at admin@thesmsfclub.com.au or contact your SMSF Club advisor. It's one aspect that we see each and every day many SMSF trustees fail at doing, which it might just be to recognise a few financial inefficiencies that exist in your self-managed super fund, whether it's to reduce tax through contribution strategies, whether it's to get money that's sitting in a cash account earning 1.3% if you're lucky, and that interest rate looks like it's probably going to be going down in the not too distant future. If you want some ideas about how to invest those funds into asset classes that offer a potentially higher return, then again, please speak to your SMSF Club advisor. So one of the things many people of you have played the game before when we ran around the country a few years ago is my board game, Diversification. Diversification, the goal of the game is to raise awareness about the long-term benefits of compound interest in a fun format to play. So if you want a copy of the board game, it's $79 plus postage. Again, email admin@thesmsfclub.com.au. It's a fun way to sit around with your family, whether it's your kids or your grandkids, to teach them about the power of investing. And no doubt you as an investor wish you started earlier and enjoyed the full benefit of compound interest. So the game tries to teach us that, to work hard, save and invest in a format that's fun and enjoyable way to spend time with your family. Now, the goal of raising the capital is actually to put it in every high school in Australia, the board game, to teach kids at school some of these key fundamentals that all of us face, all Australians face in life, whether it's saving for retirement, whether it's saving for a car or the first deposit on your house. The board game's designed to teach those kids because it's not really a part of the school curriculum just yet. So if you want a copy of the board game, then yeah, email us at admin, the SMSF Club, and we'll send you a copy. Now, tonight's presentation, if you do have any questions, then feel free to use the questions box. I'm just going to flow through the actual presentation, but at times I'll take a breather, have a sip of water, and have a look at the questions to see if we need to address anything. I'll have a look now. Anyone got any questions? We can see next slide, your view, not clear screen. I think I've changed that. So yep, all good now. Excellent. Perfect. We're working out how to communicate to each other, which is awesome. So let's look at tonight's agenda. We're going to look at the share market in review, look at the last 3 years as to what's influenced the share market and how the share market, or the ASX200, which is the underlying reference asset that's a component of, the only component of the Tailored Investment Solutions ASX200 investment. Looking at the election results, what it means for investors, share market outlook, how the investment has actually performed, your next step, and what options you have as investors moving forward. You do have two options. One is to continue with the original investment, which matures on the 6th of June, or to use the gains in the investment. Good news is that it is up. There is gains to be paid out, to use those gains to fund the next 2 years, to extend it for another 2-year term. But I'll go through those options in more detail further on in tonight's presentation. So let's look at the ASX over the last 5 years. It's been an interesting time over the last 5 years, and more specifically the last 3 years since we invested in the ASX investment. When we looked at investing, you'd remember there's a few risk management techniques that we built into the investment. The first one is dollar cost averaging. So to reduce the risk of investing on one day and the market falling the following day, what we do is we implement a standard investment approach where we go in a third and a third, a third. So we average in, dollar cost averaging, over the first 3 months of the investment. Conversely, at the end of the investment, which we're actually in the process of doing over the last few months, is we dollar cost average on the way out over the last 3 months as well. So when we first invested, the ASX 200 index was at 5,146. The next month, when we invested another third, it was 5,198, and the final third was at 5,497. That gave us the initial average entry level to the ASX 200 index at 5,280 points. Now we go forward to where we are 3 years later. The averaging on the way out, 2 months ago, we sold a third of it at 6,181. Then a few weeks ago, we sold another third at 6,283. And then the final third would be sold on the maturity date, which is the 6th of June. But if we look at where the index closed at today, it was 6,500 points, which is the highest it's been in the last 5 years. It's actually the highest it's been in almost 12 years on the Australian Stock Exchange. So it's the highest level it's been since 2007, which is pretty exciting. It's at 6,500 points, which gives the maturity averaging level 6,321. Now, I'm assuming where that final maturity averaging date is today, so at today's close. Now, it isn't. It's not until the 6th of June. So that 6,500 that I'm using for a third of it, that's going to fluctuate. It's going to go up and down with the market from now until the 6th of June, which is the final redemption date for that third. So the maturity averaging value, if we use today's close, is 6,321, which means the index is up 19.8%. So it's up, which is a good start. It's not up as much as I would have expected over the last 3 years when we initially put the investment together, but it's certainly gone in the right direction, which is a good start. Now, if we look at why it hasn't gone up as much as I anticipated, is that over the last 5 years, if we exclude the last 6 months, the actual share market has done nothing. In fact, if we go back to the last 15 years, the Australian share market is still pretty much where it was trading at back in 2005, which is almost 15 years ago. So the share market's had an interesting ride over that time, and if we focus on the last 5 years, the share market has done nothing except for the last 6 months. It's that last 6 months that the share market has increased in value, which has provided us the gains that we've received, which is close enough to the 20% rally. That's all happened in the last 6 months. The first 2.5 years, the investment index did bugger all. Now, the reason that I think the investment did bugger all over the first 2.5 years, even though it's gone up and down over that period, is that we've been plagued with a lot of negativity. We've been plagued with global growth uncertainty, led predominantly by China, which is the slowdown in what is the second largest economy. We've had interesting turmoil in the United States. The United States, while their share market has gone on from strength to strength in that time, there's been a fair amount of volatility in the underlying earnings of the companies that are listed on the US share market. Globally, we've had a lot of political uncertainty led by the US and the Trump effect. Here domestically, in that period, we've had a few prime ministers. In fact, if we go back over the last 12 years, I think we've had 5 prime ministers in that time. And not one of those prime ministers have actually served an entire term. We've had China trade tension, which continues. However, I'm confident that the two big powerhouses of the United States and China are close to reaching a deal. But that trade tension has continued to be a plague on the market for quite some time. We've had the Royal Commission into the Australian banking and financial services industry, which has plagued the Australian share market. The banks make up around 30% of the overall ASX200 index because there's been so much heat on from a regulatory perspective with this Royal Commission, a reputational perspective. That's caused the market to fall as the banking stocks have plummeted over the last few years. We've had the risk of rising inflation. We've had US political dramas. We've had rising interest rates in the United States, which has put a bit of a curb on US earnings and US consumer sentiment and spending. So as you can see, we look at all these headlines, there's been a lot of issues that have caused the market to sort of trade sideways for the last, well, excluding the last 6 months, the last 5 years. In Australia, more like the last 10 years. But if we look at why the share market has gone up over the last 6 months, we've had the prospects of tax cuts here in Australia, as in May, the government came out and said with a fair amount of certainty that they expect the economy to trade into a surplus next year for the first time in 12 years. So they've got the capacity to cut taxes. With that surplus, we've got the prospect of the government spending a lot of money. And over the last 6-week election campaigns from both the Liberal and the Labor Party, they've shown us that they're willing to spend a lot. And the reason they're able to spend a lot, irrespective of who was voted in on Saturday, they both committed to spending a lot of money on infrastructure, a lot of money to stimulate the overall economy, to create jobs and create more certainty. That big economic spending can only come about because of that surplus that I spoke about a minute ago. And the third part, which is the prospect over the last 6 months, is that it has become evident that the next interest rate movement is going to be interest rate cuts. Now, 28 out of 30 economists that were recently surveyed anticipate interest rate cuts in June. So at the next RBA meeting, with many of those economists believe that there's 2 interest rate cuts due this year, which would take the Australian underlying interest rate to close, if not below, 1% per annum, which would be the 1%, which would be the lowest it's been in recorded history. So you look over the last, that's a very busy slide that I have in front of you, but over the last 5 years, the first 4.5 years and first 2.5 years in the investment, we have been plagued with problems in the United States with interest rates and political dramas. We've got the China trade tension. which has caused the share market to trade sideways. We've got global growth uncertainty, US earnings volatility. We've had a lot of political uncertainty here in Australia. We've had a Royal Commission. We've had a risk of rising interest, of inflation. All those things have caused problems with the market. Over the last 6 months, and more particularly over the last 6 days, we have very little political uncertainty with the Liberal Party being voted in with what looks like a majority. Global growth certainty has been improved. The US are looking at stabilizing interest rates, not increase them. Inflation is off the table. It doesn't seem to be an issue with inflation, not just here in Australia, but also in the United States, which gives the ability for the Fed to ease their interest rate increases. All of these things that have plagued the market over the last 2.5 years, I believe the majority of them have been overcome. If they haven't been overcome, like the Chinese trade tension with the US, I anticipate that is going to be overcome in the not too distant future, which is why we've seen the share market rally 20% in the last few months. More recently, we've seen the share market increase by 100 points yesterday. And again, the share market continued those increases today to be at 12-year highs. The reason our share market has performed so well is that we've got the outlook where we're looking at aggressive tax cuts, big economic spending, and low interest rates. So let's look at the election result. The election result, which got me by surprise and many other people by surprise. I don't think too many people predicted such a big win from the coalition over that of the Labor Party. But it was certainly a great day for the Liberal Party, a great day for Scott Morrison. And what I believe is a great day for Australia, especially if we look at us as investors, if we look at us as SMSF trustees. Irrespective of your political view, my view from an economy, a share market, is that Saturday was a good result for investment markets, a good result for SMSF trustees, and a good result for investors. And we've seen that already by the share market having one of its best days in the last few years yesterday as a result of the election. So let's have a look at some of the reasons why I believe it's so good for us as investors and us as SMSF trustees. Now, the Labor Party came out 6 months ago with a very aggressive tax plan, which was quite negative for us as investors and SMSF trustees. I want to go through, just highlight a few of their proposed policy changes. The removal of negative gearing, where we can't claim a income deduction on losses from investments. That's a huge setback and step backwards for a lot of investors, but especially those that have invested in property and borrowed to do so. Negative gearing would reduce the attractiveness of us to go out and invest in property if we can't claim those deductions against other income. The removal of dividend imputation refunds. Now, this is huge for SMSF investors in retirement. There was headlines reading that 20% of SMSFs may close as a result of it. The removal of dividend imputation refunds essentially means the double taxation system that's been a part of the Australian tax system for a long, long time, certainly my professional career, would be essentially revoked. So if you're a SMSF trustee in retirement, where your effective tax rate is meant to be zero, if we weren't getting the refund of the tax that's already been paid on our dividend income, that's been paid at a company tax level, that essentially means that we would have an effective tax rate in our self-managed super fund of the company tax rate, which is 30%, would be 30% worse off. And that's not like an individual where we earn income and there's like a tax-free threshold. Essentially, if we remove the dividend imputation refunds like Labor were proposing, it would essentially mean you'd be paying 30% tax on $1 of all your income if your income was earned through fully franked dividends, which a lot of SMSF trustees earn their income. Half a capital gains tax discount. gain a big step backwards. Then they're going to reduce the superannuation non-concessional contributions from what is now $100,000 a year to $75,000 a year. Another big part, which I think was a huge step forward, that the Liberal Party introduced, proposed in last year's budget, was that they were having super concessional contribution catch-up relief. So we've got $25,000 a year that we can put into superannuation. If I, as an individual, don't put anything in next year, that catch-up relief means that my 25 grand carries on from this year to next year. So next year I'd be able to have the ability to put in 50 grand. Now that's great for people that have often lumpy or volatile earnings, where this year they may not have the capacity to make contributions, but next year, if it was a good year, they can put more money in. So I think the Liberal Party changes was a big step forward for a lot of Australians because it was more flexible, which is more in line with a lot of people's earnings cycles in today's income environment. So the Labor Party, looking at just a few of them as to how their policies affected us as investors and self-managed super fund trustees, if we look at their tax proposals, that was a huge step backwards, I believe. So thankfully, none of those are on the cards. None of those are on the card. And I don't think, given Labor did lose the unlosable election, I don't think there's going to be a political party that proposes anything like that in the foreseeable future, which is great news for us as investors and us as an economy. The Liberal Party, their tax proposals, low to middle income tax rebate. So if you earn between 48,000 and 90 grand, they're going to give you a tax rebate of up to $1,080. If you earn less than 48 grand, a rebate of $255. 2022, 19% threshold increase from 37 grand to 45 grand. 2024 cuts, they're cutting the entire 32.5% marginal tax rate and reducing it to 30%. And in 2024, they're going to eliminate the 37% tax bracket altogether, which essentially means that if you earn between 45 and 200 grand, you're in this massive tax bracket where you pay 30% tax on income earned over 45 grand. All these things are tax cuts. They're aggressive tax cuts. It puts more money in most Australians' back pocket. If we've got more money in our back pocket, we spend it, and that stimulates the economy, which should flow on to companies' profits, which causes the share price and share market to go up. So they're all positive. So if we look at what does the election result mean for the Australian share market, that's a little cartoon. I made a modification of it today. There's Scott Morrison with his grin, pushing the share market up. A coalition win ignites $33 billion ASX firecracker. Australian shares soar to 11-year high on Monday as investors welcome the surprise re-election of the coalition, adding an extra $32.8 billion to the bourse. The ASX200 rose 110 points, 1.7%. It closed out yesterday 6,476 points, and today it closed at 6,500. So those gains have increased. You guys can hear me, right? I just got looking at the comments. I heard someone mention they can't hear me. Everyone good? Yep, excellent, perfect, loud and clear, excellent. Stock market powers to a 12-year high after coalition victory. So this is just some of the news headlines over the last few days. What's interesting also today is one of the first steps moving forward under this coalition government, which seems to have a majority, is that we've got a huge step forward for investors. APRA have come out and signalled the end of a hurdle that saw all borrowers assessed against their ability to repay the interest expense at 7.25%. So you might remember over the last 12 months, it's been very hard to get a loan for investment property. I'm sure many of you online have found it a lot more difficult over the last 12 months than what you have previously in your entire life. One of the reasons was that APRA was imposing a serviceability calculator. So irrespective of the interest rate that you're actually borrowing at, they've essentially made it mandatory that the banks assess at 7.25%. Now, interest rates outlook over the next few months means that the actual interest rate charged could be half that. It could be in the low 3%. Like even now, many people have got loans under 4%. So to assess a person's ability to repay that loan on double the interest rate makes it very, very tough for borrowers to borrow money. So today, the APRA have said that they're going to end that hurdle where banks don't need to assess your ability to repay the loan at 7.25%. They're going back to the old rules where they're going to let the banks determine what sort of serviceability requirements that they impose, which for most banks should be a lot less than the 7.25%. So again, a great step to remove hurdles for people to go out there and save and invest and be proactive to fund their eventual retirement. So they're not a burden on the rest of the economy where they're relying on the age pension. I think that's one of the main reasons the coalition got elected. They're all for empowering individuals to go out and become self-funded in retirement, not rely on the pension, whether that's through removing the hurdles for investors to go out and borrow money to buy property, like in today's announcement, whether it's to reduce taxes to give people more money in their back pocket to go out and invest and spend. So what's the election result mean for the share market? It's very, very positive. And that's going to be led by three main things: tax cuts, government spending on infrastructure, not just simple handouts, and interest rate cuts. They're the three reasons why I'm very optimistic the Australian share market has got a very solid 2 to 3, 4, 5 years ahead of us. So let's look at the facts of our economy. We're returning to surplus. If you look at returning to surplus, we go back to the last time that we're in surplus was under John Howard era, which was 12 years ago. And since then, we've been in deficit. Now, in the 2018-2019 budget, the government came out and said we anticipate to return to budget next year, which is great news because when they go to surplus, they've got excess money, and generally that encourages them to go out and spend. Economic growth forecast is expected to increase from 2.25% GDP growth to 2.75%. We've got low inflation, which is at the lower end of the RBA's target range. Low interest rates, 1.5%. Why low inflation is important is that one reason why governments don't reduce interest rates is because it generally has a flow-on effect to inflation, and inflation increases, that is detrimental for the overall economy. So when inflation is low at their 1% range, well below the 3%, the government has the capacity to lower interest rates to stimulate the economy. How they stimulate the economy is if they lower interest rates, the majority of Australians' biggest cost is interest on their mortgage. If that cost is less, we've got more money in our back pocket, we go out and spend more money. When we spend more money, that flows through to companies' profits, which in turn causes share prices to go up. It's pretty simple. 28 out of 30 economists expect at least 2 interest rate cuts this year, which is interesting. Reserve Bank poised to cut interest rates in June. This was an hour ago. It's probably 2 hours ago when an hour ago I included these slides. The Reserve Bank governor has given the strongest indication yet that interest rates will be cut in June. RBA rate cut expectations to go into overdrive. The CBA has become the last Australian Big Four bank, the last, so not the first, the last. So that the other three have the same view to forecast rate cuts for the RBA in the months ahead. It expects the RBA to cut rates by 25 basis points in both June and August. The cash rate hasn't been cut since 2016, which is when we went into this investment, or pretty close to it. CBA says there's a very low probability that the RBA will cut the cash rate below 1%. So they're expecting 25 basis points in June and 25 basis points in August, and then for it to stabilize around the 1% official cash rate. Financial markets are pricing in 50 basis point rate cut by November this year. So that's the 25 basis point cut in June and August, which will take it down to 1%. Now, 1% and reducing it by 0.5% doesn't sound like much, but we're going from 1.5%. If we're reducing 0.5% on 1.5%, That is a third. They're cutting rates by a third, 33%, which is a big number. We'll look at case for rate cut in June, RBA says. Again, if we combine with rate cuts with the APRA announcement today that it's loosening their home loan rules, it will help some borrowers access a mortgage. I'm very optimistic, not just on the share market, but also the property market. The property market, if we look at the key capital cities in Australia, have sort of been or stagnant, if you believe the media, have fallen a little bit. One of the reasons why I believe the market has fallen, and the Australian share market hasn't done much over the first 2.5 years of the investment, is because everyone's been sitting on their hands. Not because we want to sit on our hands, it's just simply the banks, with the Royal Commission, with the high regulatory environment, with APRA's increased requirements, the banks it's almost made the banks impossible to be able to lend. Now that's all been loosening. We've had the Royal Commission. It's over and done with. So I anticipate banks are going to turn their focus not on their reputation, but making a profit. So after all, that's what directors are employed for, is to ensure their reputation, and they've got to do things ethically and honestly. But after all, the reason they're employed is to make a profit, and for that profits to flow through in dividends to shareholders. It's pretty simple. But with APRA softening already, what we're Tuesday after election on Saturday, they've already decided to relax the rules to enable banks to lend more to investors and to first home buyers. That should stimulate the property market and get a lot of people off their hands and a bit more activity. That's what's anticipated. Overlay the APRA regulatory requirements being relaxed, the Royal Commission being over and done with interest rate cuts, then we've sort of got a perfect storm to look forward to ahead. Low unemployment, which is sitting at approximately 5%. Then we've got the big economic spending, as I mentioned before. Now let's look at the big economic spending. Now to get your vote, the government and the Labor Party, who didn't get elected, promised some pretty big spending. The total national spending barometer for 2019, which was pretty close to the end, the Labor Party was promising close to $70 billion in total spending, where the Liberal Party was $62 billion. Now, why this is different, I think, than the previous stimulus package, which was led by Rudd. If you remember, you go back to 2009, Rudd came out with the I think it was the Kevin 37, which was the 37-inch TV. He was handing out $1,000 to the majority of Australians, and the aim of that was to stimulate the economy. It was just a straight out handout. The problem with handouts is that you give a person $1,000, it essentially got spent at Harvey Norman. They did go out and buy a 37-inch TV that was made in who knows where, but I bet it wasn't made in Australia. So by putting a handout like Rudd did back then, it was really only an economic stimulus package for one instant hit and for one person, and that was Jerry Harvey. It didn't get reflowed around the economy. Now, what's different this time is that while they're promising to hand out a lot of money, and $62 billion is a lot of cash, they're not doing it in handouts. They're doing it in tax cuts. They're doing it in infrastructure upgrades. Now, I've got a few things in front of me just as a few of the ideas. Rockhampton Ring Road, $1 billion in Rockhampton. So it's regional Queensland to create jobs. When it creates jobs, that money goes into people's back pockets. That back pocket gets spent in the economy. It gets spent at the person selling the pie at the corner, right? And that helps his small business. And then he goes in and invests in his mortgage. Then it goes and spends it at the person down the road at Bunnings. It gets stimulated and rolled around in the economy. Hospital upgrade package of $1 billion. Increase in the low income tax offset over the next 4 years, $16 billion benefit. Tonkins and Roe highway upgrades in WA, over $1 billion. M1 extension, Black Hill to Raymond Terrace in New South Wales, $1.6 billion. Childcare package, $4 billion. Pensioners dental plan of $2.4 billion. Melbourne suburban rail link, $10 billion. Fast rail, Melbourne to Geelong, $2 billion from 2021 to 2022. First stage of the Western Sydney North-South Rail Link. Melbourne East-West Link. So this is all money that's being spent as a big component of that $62 billion. It's been spent in infrastructure, and infrastructure doesn't just give you an instant one-off hit. It stays in the economy. It helps create jobs, not just now, but for decades into the future, which is the smart way of spending the money. And how that's come about is because we're in a surplus, right? The government's got more money in their back pocket, so they can promise this level of spending to stimulate the economy, create jobs, to increase the share market, increase the profits of the companies that are listed. That's where it all flows on to. So the facts on our economy: we've got a returning to a surplus. Economic growth is looking to increase. We've got low inflation, low interest rates, which are expected to be cut by a third, from 1.5% to 1% over the next 6 months. We've got low unemployment. We've got big economic spending. So if you look at the tax cuts, big economic spending, low interest rates, it is a perfect storm, which is very different to what we've experienced over the last 20 years. If we look back at Kevin Rudd and why our share market hasn't gone up since the GFC, is that there was no tax cuts. There wasn't economic spending. And our interest rates from 2009 to 2012, if you remember, weren't reduced like everywhere else in the world. They were actually increased. They were increased during that time when everyone else was cutting it. And that's plagued our market ever since. We're playing catch up to the rest of the world. But I think where we are today, our economic position, our economy is in a very stable position for the next 5 to 10 years. I've never felt more optimistic about the share market and our economy than what I do today. So let's look at why I'm optimistic. Now, I'm not just optimistic looking at these 3 key factors and going, I hope it's going to go up. What I'm looking at as an economist is, well, what countries have been in a similar situation than where we are today, where they've had record low interest rates that look like they've been cut to move forward? Where have they had a lot of government spending? Where have they had aggressive tax cuts? And the easiest way to look at what I think the share market is going to do over the next few years is to look at the US share market and what's happened over the last 20 years at different times when the government has done exactly the same thing. The government stimulate the economy, right, by cutting taxes, spending money, and dropping interest rates. They're the 3 policies that they implement to impact the economy, which in turn affects the share market. So 2003 after a downturn, the United States cut taxes, interest rates were cut, and they increased government spending. And the share market went from like 7,500 points to almost 15,000 points. It almost doubled over the next 5 years. Then we had the GFC. The GFC occurred, and then the government goes, what do? Again, they did exactly the same thing. They cut interest rates, they increased government spending, and they cut taxes. You go forward to 5 years later, the share market went from 7,500 points to well over 15,000 points. Then we had the Trump effect in 2016. Now, it wasn't because of Donald Trump the share market increased. It was what he stood for. He stood for increasing government spending, cutting interest rates, and cutting taxes. The share market has boomed since. If we looked at the Trump effect, that's when Trump was elected. So if we zoomed in on that chart, 12 months later, the Dow Jones, which is the measure of the US share market, the main one that people use, like the ASX200, but the Dow Jones is what they call the measure of the barometer of the US share market. After Trump was elected, the Dow Jones was up 23%. Why? Tax cuts, big economic spending, and low interest rates. Pretty simple, right? The economy can be quite simple. It's not that complicated. So where you look at where we are today, look, Trump's been elected. We've had ScoMo, the Messiah from the Shire, get elected in the so-called unlosable election. He's won it, and he's proposing aggressive tax cuts, big economic spending, and interest rates look like they're going down. It's no wonder the share market was up 100 points yesterday and up again today. It's not just me who realizes that those 3 economic drivers have a big impact on companies' profits and the share market over the medium to long term. Here's the Australian share market over the last 10 years when we compare it to the US. Now, the US is the blue line. Ours is the orange line. The blue line, 3 times over that period, they've had aggressive tax cuts, they've had increased government spending, and very low interest rates. And we've seen the US share market go up and up and up, where the Australian market has gone sideways. The reason our market's gone sideways, if we look back at that catalyst, that point back where we've got the divergence, back in June 2010. I'll get this thing here. Let's see if I can draw something. This section here, the reason that the US market has gone up is because of those 3 reasons before: tax cuts, government spending, increased government spending, and low interest rates. Where here we had the cut government spending, increase interest rates, increase taxes, though the complete opposite. As a result, we've seen our market goes sideways until where we find ourselves now, where the government, because we are in a surplus, they're prepared to spend more. We've got low inflation. We've got inflation at the lower end of our target, so the RBA can cut interest rates even further from where we are today. Because we are in a surplus, we can also reduce taxes. So we can finally, 10 years on, implement the policy changes that the US have been doing 3 times over the last decade that's caused their share market to go up, while our share market has done nothing. So I'm hoping that we're going to catch up to the United States or come close to it. I'm hoping that gap is going to get smaller. Not by the US market falling, but from our market increasing. I'm not saying our market can go up 142% in the next 2 years, but I think where we find ourselves today, I'm very optimistic about the outlook, that it has got the capacity to actually reduce that gap quite significantly. Well, I don't know how to get rid of that stuff. Bear with me one sec. Ooh, there we go. So we're in a good position. We're in a good position where we're anticipating tax cuts, big economic spending, and low interest rates. So let's go to the investment. Now, the investment that you invested in back 3 years ago, that's maturing in a few weeks' time. The 6th of June is a maturity date. It gave you exposure to the ASX200 index, the Australian share market. It was a 3-year investment term. Now, you invested and you borrowed the full amount in a 100% limited recourse loan. So if you had $100,000 units, you had $100,000 exposure to the index, and you had a $100,000 limited recourse loan. The interest rate was 4.95% per annum, which was fixed for the 3 years. There was a hedging cost to get the limited recourse borrowing arrangement of 2.2%, which was fixed per annum. Now, over the investment term, there was a fixed coupon which relied on gains. Now, the end of year 1 and the end of year 2, 4.95%, which is essentially 5.5% less our 10% performance fee. So you were essentially paid out 4.95%. Now, you didn't get that money. That money was used to offset that interest and the hedging costs. So that coupon offsets the interest cost, which meant in year 2 and year 3, you only had to pay the 2.2% to continue the investment for that year. So if you remember up front, you paid the interest cost, the hedging cost, and advisor fee. That was for the first year. The second year, you paid 2.2% of your loan amount, which was the hedging costs. Of course, the coupon offset the interest rate in year 1 and year 2. Now, that coupon is paid out of gains, right? So when it comes to the maturity value, of course, you've already received the 11% that comes off the final value. Every year you had the option of walking away. Thankfully you didn't, because it is up. So if we look at the returns, year 1 from a cash flow perspective, you prepaid the 4.95% interest and the 2.2% hedging fee. That was your outlay year 1, which is $7,150. There was an advisor service fee, which goes to RM Capital, our licensee in the SMSF Club, for putting the investment together. It's $2,200. So your initial outlay was $9,350 for year 1. Year 2, same thing. You had the investor outlay of 4.95% plus a 2.2% hedging fee, which is $7,150. There's a $4,950 coupon that was paid. That meant the cash flow, the cost out of your back pocket was $2,200. That was what was direct debited. Year 3, same as year 2. $7,150 less the $4,950, which is $2,200. All good? So where we look at where we are today. So the investment, while the first 2.5 years of the investment did very little. The last 6 months has boomed as we've got the outlook as being a lot more certain, a lot more improved than what it has been over the last 5 years. So we went in 5,280. It's now 6,321, which is a gain of 19.8%. It's all been achieved in the last few months. So from the performance of 19.5%, well, it's 19.8%. It is the gain. The 19.5% didn't include today's rally. So the less the coupons that have been paid, they're paid out of gains. As I said, that used to offset your second and third year interest. The final value, if we assume where we are today, is $8,800. So if the index is where we are today, the final value is $8,800. That's what you get back. Now, while it's gone up, unfortunately, it hasn't gone up by enough to cover all of the costs. So there is a small loss. It's only a few percentage points or a few grand on 100,000, unfortunately. But it's certainly gone in the right direction over the last few months. If we were doing this investment and matured 6 months ago, you would be getting nothing back. So it's great that we're getting something back, and that gives us the capacity to use those gains to fund the next 2 years without it costing anything out of our back pocket. And that's where we come to the decision you need to make as to what you do with those funds. So you have two options. The first thing is do nothing. You do nothing, you go, you know what? Thanks very much. I'm taking that $8,800. I'm going to do something with it. Now, with your self-managed super fund, you got a few investment alternatives, which aren't that much, but it's to invest only, right? So the first thing is to do nothing. You do nothing, you will be paid whatever the final value is in a few weeks' time into your nominated bank account. That final value is going to be determined by what the ASX200 index is trading at on the June 6th. Keep in mind, though, we've already sold 2/3 over the last few months as part of that dollar cost averaging exercise to reduce the risk of the market falling in the last few months. The second option is to extend the term. Now, as I said before, I haven't been as optimistic about the share market as I am now. I'm optimistic because of the government situation where they can spend a lot of money. They've already promised to do that. The outlook for the RBA is that they're going to be cutting interest rates, so we're going to have more money in our back pocket, and that should be able to be spent, and that flows on to company profits. And if company profits increase, then the share price of those companies and the market should increase in value, like it did in the United States in 2003, like it did post-GFC, and like it did in the Trump era, and continues to do. So what we can do is, rather than be paid that $8,800, what we do is we use those funds to pay for the next 2 years. We use them to pay for the next 2 years interest expense and the hedging costs, and those costs have gone down from where they were for the first 3 years of the investment. So if we look at an example, if you've got 100,000 units, the final value is 8,800 where we are today. What we're essentially doing, if you choose to extend the term, we use this coupon to pay the entire cost for the next 2 years. So it doesn't cost anything out of your back pocket. All that we're doing is utilizing those unrealized gains to fund the next 2 years of the investment. The interest rate, 3.4% times 2 years, 6,800. Hedging cost is 1% per annum. So that's the total cost for the 2 years is the 8,800. That gets offset by that final value, right? So we use the gains to fund the total cost for the 2 years. So it doesn't cost you anything. We reset the investment term. That starts on the 6th of June or the week after the 6th of June. We essentially collect the money and we extend it for 2 years, and we start a few days later. So it doesn't cost you anything. The net cost of the extension is nothing, and that gives you exposure to the Australian share market for the next 2 years. So let's go to a few questions. I think there is finally some great forward thinking. Yes, there is some great forward thinking. All good from here. That's right. Yes, yes. A few yeses. Excellent. We should have invested in the Dow Jones. Good point. Look, the United States share market has gone up a lot. And one of our best performing investors that a lot of you have got exposure to as well has been Berkshire Hathaway. Now, rather than the Dow Jones, Berkshire Hathaway has been a phenomenal performer. Warren Buffett has created huge returns. So, look, one thing, I haven't looked through the analysis, but I know a lot of investors have invested just in this ASX 200 investment, which is a bit frustrating because you have missed out on how other economies and how other assets have performed. Had you invested in the Berkshire investment as well, you would have made some pretty healthy profits. So, don't just invest in one thing. A lot of investors here at the SMSF Club have also just invested in property, and that's all they're invested in. And in some markets like Brisbane or Sydney or Melbourne over the last few years, it's done nothing. So you haven't made any money. The key to making money, if you look at the board game, is to diversify, is to spread your assets across all different asset classes. Just make sure that those asset classes are solid and in line with your overall investment circumstances. But I think the key catalyst to come out of the board game and the presentation and the last 20 years of my investment professional career is that you don't want to have all your eggs in one basket. What you need to do is look at different economies and different asset classes. I own property. I've got exposure to Berkshire Hathaway is one of my largest investments, and I've got exposure to the Australian share market. The reason why I've spread across all of them is that they have often, and it's been more effective over the last 10 years where property, the Australian share market and the US share market have worked in different cycles. Diversification, JB Way. 101. There you go. What happens to the original investment capital? That's a good question. Like if we go back, your original investment capital, let's go through it. Hang on, I think I haven't got to it. So this is your original investment, right? Year one. If you invested for 100,000 units, I'm using 100,000 units just as an example, okay? You invested $100,000. You borrowed 100 grand. Right? There was a loan that you borrowed. It was for the 100% of the initial investment. That was through a limited recourse loan. You then prepaid the interest and the hedging cost. Now that cost you money out of your back pocket. That was the $7,150. Right? That's interest. That's holding costs for borrowing the $100,000. There was the advisor service fee that went to the SMSF Club and RM Capital for putting the investment together. So the total outlay is $9,350. So if you look at your outlay, that is $9,350 for the first year, which was interest, right? It's interest. It gets eroded over time because you're using someone else's money to invest. Year two cost you $2,200. That was the shortfall between the income and the interest and hedging fees for year two. That's what it cost you out of your back pocket. Again, that was carrying costs. Year three, 2,200, same as year two. That's the carrying cost of the investment. So like you look at your original investment, that was for interest and hedging costs. So that is eroded over time. So where we're at today, where the investment is up and you get paid out 8,800. We use that 8,800 to prepay the cost for the next 2 years. There's nothing to pay next year. There's no shortfall, right? It's covered it all for 2 years. Those two offset each other. However, if the ASX 200 index doesn't go up at all and goes down, you've got the limited recourse loan. So you walk away from the loan, you walk away from the investment. But if the index doesn't go up over the next 2 years, you lose that 8,800. Does that make sense? Because that's interest for borrowing the money to invest. That's right. If you do nothing, look, the total outlay, the total cost out of your back pocket is around 13 grand. I don't have the exact numbers, but you've outlaid around 13 grand, and right now you're getting just below 9 grand back. Yeah, so that it is a loss. Your gains haven't been enough to offset that carrying cost. But remember, we haven't experienced 3 years of gains. We've only enjoyed 6 months of gains. The first 2.5 years was a market going nowhere, which was plagued by a lot of different factors. Like if you buy a house over the last 3 years, let's assume the property market doesn't go up. You don't sell the house, right? You continue to hold it for the long term. That's what we've got the opportunity to do with the extension units. And it doesn't cost you anything out of your back pocket, right? We get a free ride essentially for the next 2 years. That's what's on offer and what we've spent a fair bit of time with the investment banks to put together. We've negotiated a lot cheaper interest rate and hedging costs. We pass those through to you as investors. What is their outlook on commodities? Well, look, the outlook on commodities is up and down. I suppose commodities is such a broad topic. There's gold, there's silver, there's as precious metals, there's energy as commodities like oil and gas. There's commodities like as in soft commodities being food. So I think over the long term, my belief is that I anticipate commodity prices to increase as China and India become more and more westernized and their need for commodities increases. So over the long term it is, but like if you look at what my outlook is for iron ore in the next 6 months, I've got no idea because it's going to be a key driver from Chinese consumption. Iron ore is quite high, the price. It's probably the highest it's been for the last few years, which is good for Australia. One of the reasons probably why we're in surplus, because we do dig shit out of the ground and sell it to China. So look, my outlook for commodities is solid, and depends on the two. Let's go through. No, the payment is on capital account. It's not on income account for tax purposes. Oil and gold, I think oil and gold are cheap. We've seen oil prices increase just recently. So my outlook on oil and gold is still optimistic. Just to go back to the question on commodities. Question, the holding costs seem to be higher for the next 2 years as to the past. That's not the case. The interest rate for the first 3 years was 4.95%. Now it's 3.4. The hedging cost for the first 3 years was 2% per annum. It is now 1. So the cost for the next 2 years is a lot less than what we've paid per year for the first few years. Is there a coupon paid out after the first 12 months? No, there isn't a coupon that's paid out after the first 12 months. It's paid at maturity, but there is the ability to redeem the investment every quarter. So in 12 months' time, and the market goes up, let's call it 30%, just to exaggerate things, and you've got 30 grand, you can take the 30 grand, take your profits and run, or a portion of it. So the liquidity gives us the ability to take profits. If it's down, you wouldn't redeem, you'll just hold until maturity, but great question. What's ASX have to grow to for us to see a return on our investment? So right now, we need the investment to go up essentially 8.8% over the next 2 years. So we need to go up 4.4% per year for the next 2 years for us to be in a better position than where we are today. So if you look at the alternatives to take the cash of the 8,800, in 2 years' time, if the market is up, let's call it 10% per year, that 8,800 that you haven't taken today will be worth 20 grand in 2 years' time. That's if it goes up 10% for the next 2 years per annum. If it goes up 20% per annum, like the Donald Trump effect of what we've experienced over the last 6 months, if it goes up 20% per annum over the next 2 years, then your 8,800 is worth 40 grand, which is 4 times what we're risking. Look, while that's an optimistic outlook, that's what the United States share market has done in the years that have followed 2003, 2009, and more recently with the Trump effect. It's gone up over the 20% per annum mark for a few years. So Well, that's optimistic. Even if it did half that, we're tripling our money, which is a great outcome, right? So it's time. That's gone for the hour. Look, following on from here, you do need to fill in a form either way. To receive cash, we need to get a form completed at maturity to redeem. Also, to extend it, we need a form for you to sign. So the next step is look, contact your advisor. Send me an email, justin at thesmsfclub.com.au, saying what you intend to do, whether it's to extend or whether it's to cash out and redeem. When making the decision, though, sort of treat it like a property investment. If a property doesn't go up for 3 years, you don't sell it and go, that was a shit investment, let's go elsewhere. This investment has gone up. With property, you've probably got a loan and carrying costs anyway. It's similar with this investment. Rather than just going, look, I haven't got back the amount of money I spend interest, which is the case, right? The outlook is very optimistic. The outlook on the share market is very, very solid. So don't throw the baby out with the bathwater. Have a look at your situation. Look at where else are you going to invest the money? What is the other alternatives to invest that $8,000 in the case study for the 100 grand, whatever it applies to you, and assess what investment options you've got available to you right now versus the outlook of the Australian share market. Our Australian share market has done nothing for a long period of time. When this thing turns around, I think it's going to turn around very, very quickly, which is why I'm so optimistic. I've gone from being cautiously optimistic back in 2016 to very optimistic where I sit today. And the reasons, because of that, is what I've spoken about tonight. The government's situating on a surplus. They're cutting taxes aggressively. They're going to spend a lot of money on infrastructure, and we've got interest rate cuts that are highly probable in the next few months. When you overlay those three things, throughout history, that has had a very powerful effect on the upside to share markets and economies. So that's it from me. Send me an email on what you need to do and or what your intention is. I'll also have Grace look at organising some phone calls with you guys individually. So if you'd like to get at the front of that queue, send me an email or Grace an email, and we'll organise time to go through your circumstances. So thanks very much for tuning in. Happy investing and good night.